Welcome to Live the Dream with yours truly, Marty Kaiser. Buckle up and let's get started. Happy Friday, everyone. This is Marty Kaiser with our Friday edition of Real Estate Tidbits. I hope everyone's having a great week. We had some interesting weather. We had a couple of really cold days, and the last few days have been really nice, so it looks like we got very favorable weather forecast for the next few days. So I hope everybody enjoys it and gets to go outside. So today I'm going to go over a few different things, and I thought they may be interesting. The first thing was there was on the news a new proposal, what I would say unofficially was broached about a 50-year mortgage. And this was just something that President Trump had mentioned on one of his social media channels regarding trying to boost up the real estate market and make it, from his perspective, more affordable, especially for people that are renters right now. So I'm pretty familiar with most mortgage plans. About 20 years ago, we had 40-year mortgages in a small sampling with a couple of lenders. And they ended up overall not being good at all for most consumers. So I had my own skepticism of the 50-year program mentioning, but the reason I'm bringing it up today, it just came out in the last 24 hours that the Treasury Department pretty much felt that that's not a concept that will be implemented. One of the assistants to the Treasury Secretary was asked during a TV appearance whether he thought the proposal was a good idea. And of course, he tried to talk in generalities and ambiguities, but he basically said that it wasn't an optimal approach. And the reason it's really not an optimal approach, both from my perspective and what this gentleman had mentioned, is that here's what ends up happening. Your payments are lower, so they're a couple $100 a month lower, give or take, depending on the size of the mortgage and other information. But what ends up happening is you're paying back hundreds of thousands of dollars of additional interest over the life of the mortgage. And our system is somewhat predicated on people being able to sell their house within a certain amount of time. And then if things are going favorably for them financially, as their family size grows, et cetera, they usually try to move into a larger house, maybe one that's in a more preferential neighborhood for that family, whether it's a better location, better school system, whatever the case may be. So, for example, in Florida, for the most part, it's very common for people to sell a house within a 5 to 7 year timeline. And I've been in the real estate business for a number of years, and I found that timeline to be very consistent. A lot of my customers over the years have exactly met that criteria. So that one of the troubles with the 50-year mortgage plan would have been that if you were looking to sell within 5 to 7 years, you just wouldn't have gained enough equity, because with any mortgage, you're pretty much for the first few years primarily paying interest anyway. But with a 50-year mortgage, you're really paying no principal at all during the early years of the mortgage. So when you're going to sell, if you're in a normal market where, let's say, the appreciation is 3 to 4% a year, you just haven't built up that much equity. So that's one of the reasons. Also, a lot of times when you go with these creative mortgages, the interest rates tend to be a little bit higher. When we had previously the 40-year mortgage, and then we went into a housing bubble at the same time within a few years of the 40-year mortgage's implementation, what ended up happening was borrowers took out larger loans than they could otherwise afford. They were slower to build equity, as I mentioned. And because the prices started decreasing during this particular timeline, many people just walked away from their mortgages when the home prices decreased. And so that was one of the main attributes to when we had the housing bubble and all the short sales and foreclosures in the timeline from 2008 to 2011. And basically, as I mentioned, your payments would be cut by a few $100s, but that otherwise all the other fallouts from this would be negatively. And this was also agreed to by Realtor.com senior economists. They also thought it was not a good idea. So I think the consensus was this is not the best way to solve housing affordability. Basically what needs to be done, as we've talked about, besides hopefully the interest rates going down a little bit, more importantly is we need to see more housing starts and some different incentives to make it not only easier for people to buy, but also to make it a little easier to encourage builders to build modest-priced homes to help out that first home purchase or buyer segment. Right now, a lot of the builders, because of appreciation and the rising cost of materials, especially exacerbated by the tariffs, not only have slowed down their housing starts, but they look to build at bigger price points. And of course, one of the things that consumers don't like because of the rising prices are that a lot of your lots, and a lot of your houses rather, that are being built on very small lots. And what the small lots do is they basically give you a lack of privacy. You're right on top of your neighbors. And if you have small children or pets, you just don't have a lot of property for them to utilize. So that's another downside to not creating scenarios and making more conducive for builders to build a product that first-time buyers can enjoy more. So anyway, I think the 50-year mortgage is going to die a quick death. But anyway, it's always good to come up with concepts. Sometimes you'll hit on one that's good. The next thing I wanted to go over relative to the real estate market and also the interest rates. And again, this was a current article that I was reading, and it very, very enlightening. This was from the Wall Street Journal. And basically, the headline of the article was Home Builders Rate Buydowns Are Leaving Buyers Underwater. And they mentioned a few of the larger national builders that do a lot of business in the Orlando market. And I won't mention the names of the builders because I don't like to highlight negative things unless it's really crucial. But suffice to say that these were big builders and they built a lot of homes in Orlando. And some of the statistical data that you would find relative to these builders that I'm mentioning is that approximately 1/4 of their FHA loans, and FHA loans are a popular loan for first-time home purchasers usually, because they allow a little bit lower credit score and they let a buyer get into the house with a 3.5% down payment. So basically, loans that were originated between 2022 and 2024 that were utilizing what they call rate buydowns, those folks are underwater now, which ultimately means that we could have more foreclosures, especially in that segment. A lot of them experienced negative equity, especially during the 2024 year, and they've been showing higher underwater rates. So this is very concerning both for the real estate market, our overall economy, and individual builders. The thing that we want to stay away from, obviously, is another meltdown where we have a lot of distressed properties going on the market. But if you get people underwater and they experience some type of negative event that's of significance, a lot of times, from their standpoint, they just rather walk away from the property than to continue to pay on something that they have no equity in. So that's one of the potential risk of buy downs. Now, the concept with buy downs on the surface is good in the sense that, let's say the interest rate was about 6.5%, what they call the par rate, and they offer maybe a 2-1 buy down or something similar. There's a couple ways they can do it. Sometimes the rate will go down for the first couple years of the mortgage. Other times it may go down over the life of the mortgage. The thing is, most of these new home builders, when they're offering these buy down rates, they've incorporated these into the price of the homes. So really the people aren't getting the savings that they think they are. In other words, they might think they're going to have a house payment maybe of $100, $150 a month less, whatever the case may be. But the builder has increased the price. So let's say if they were going to sell a house for $400,000 without a rate buy down, maybe in that particular neighborhood, or if they were focusing on rate buy downs, they would raise the price of the home maybe by $10,000 or $20,000. So at the end of the day, the buyers were paying an inflated price for the home. But it's like when people have bought cars in our country for years and years, one of the things that car dealers do, which is proven to be not necessarily a good thing for car consumers, is when you go to meet with a car salesman and they review your payments with you, one of their strong techniques are, well, what kind of payment are you looking for, Mr. Consumer? So let's say the consumer says they'd like to keep their car payment at $300 a month. So what they do is they tailor that program to a $300 a month payment. So for example, back in the day, 20 years ago, give or take, it was pretty standard that most car payments were set up on a 3-year basis. So after 3 years, your car was paid off. And that way, if you were going to trade in your car after 3 years, you would build up an asset, because let's say if you bought a $20,000 car and you paid it off after 3 years, maybe it was worth $12,000, $14,000, whatever the case may be. So now when you went to buy a new car, you could use that for a good-sized down payment. But what's happened with this creative techniques, and also how the prices have increased significantly with new cars, is, let's say that example I gave you where the person said they wanted a 3-year car payment. A $300 a month car payment, I'm sorry. Maybe then in order to get that, the car salesman would have to quote a 6 or a 7-year car loan. So what ends up happening is the people never build up any equity in the car, and they're frequently, the term is underwater. So when they go to buy their next car, they actually owe more on the car than it's worth. And that's after making payments for a certain number of years. So really and truly, it's not a good situation for the car consumers. But that's why I try to counsel people, not that I'm in the car business, but when you go to buy a car, you should never tell the salesman what kind of payment you want. You should factor it in on how quickly you can pay that car off. And my recommendation to most people is, if you can't pay a car off within 4 years, then you shouldn't be buying that vehicle. But that's, that way to keep you in a good financial situation. And it's kind of the same thing with a house, but on a much larger scale. If you're doing these buy down rates and the price of the home has been inflated, then when you go to sell the home, you don't have as much equity build up as you would have expected. So those are some things that people need to be aware of. And it's starting to impact builders, because the new home builders, as the business model slows down a little bit in our market, they've been trying to come up with more creative techniques, and the buy down rate is one of those. So you should make sure, as a home buyer, it's fine to take advantage of the buy down rates, but you need to make sure you're getting a good value on that home. And if you're paying an inflated price for the home, you should be very careful of that. And from the research that this article also went on to talk about, they estimated that about 2/3 of new homes sold by the largest builders, which provided permanent rate buy downs, they don't count those as seller concessions. And so what that means is it's harder for smaller home builders to take advantage of the loophole, in which the builders pay a bulk forward commitment fee to gain access to a larger pool of mortgage funding at more attractive rates. And the reason that that's an important distinction, without getting people too technical here, is that our two biggest lenders, Fannie Mae and Freddie Mac, they limit seller concessions to 3 to 9% of the purchase price. And FHA sets a limit of 6% in most cases. So what that means, let's say you're buying a $500,000 home, and you have let's say you have a 3% concession limit. Well, that means that the builder legally in that scenario could only give you $15,000 worth of closing concessions. And if you parallel that to these big buy downs, which have a greater amount than that 3%, and they're able to get that loophole where the buy down is not considered a concession, then they can offer a larger concession, number one. Number two, it could create that scenario that I was talking about where you're not paying market value for that house. But thirdly, it does create an imbalance in our new home market too, because we have a lot of smaller builders, and they're not in a position to take advantage of that concessions due to that pooling factor that I mentioned. So these experts felt that are analyzing Fannie Mae and Freddie Mac, that the FHA should end that exemption. And according to what President Trump said on his social media in October, he stated that builders are sitting on 2 million empty lots. And of course, he's asking Fannie Mae and Freddie Mac to get the big home builders going. And unfortunately, there is a conflict of interest also, because the head of Fannie Mae and Freddie Mac's regulator, the Federal Housing Finance Director, Bill Pulte, told an industry publication last month that they're reviewing all types of things relating to pricing, liquidity flows, etc. However, what's kind of gone under the radar is Bill Pulte, his family, and himself, because he's the CEO, they own one of the largest home builders in the United States, Pulte Homes. And Pulte does a lot of business in Orlando. And there's been a lot of mixed comments about Bill Pulte's performance so far and how he interacts with different people and stuff. And I'm not in the regulation business, so I'm not going to comment on that. I'm just going to say that it seems like that could be definitely a conflict of interest. You've got the owner of one of the biggest builders in the United States in a regulatory function. So that would be a big concern to me. But anyway, I thought that would be interesting to you. The last thing I'm going to go over today, and this will be of interest to buyers that are what I call empty nesters, or maybe adult children of empty nesters that are trying to help their parents plan for what we call their golden years. So what I mean by that is people that we would consider senior real estate customers or empty nesters. There's a lot of those right now in the United States, what we call the baby boomers, because that's the biggest segment age-wise. And so a lot of baby boomers have built up a tremendous amount of equity. In fact, a lot of them have paid their houses off. And if they've owned their house for a good bit, when you combine paying their house off with all the equity that that the house has appreciated, they're in a good financial position. And many of those customers, they don't need the space. Their kids are all out of the house, so they want to get something that is more maintenance-free, possibly that they can interface with people more in their own age group, take advantage of social activities, etc. And so when you're consulting with this segment of the folks, what we call the senior homeowners, how can we transform their downsizing experience? Because it's a big thing for people that have owned the home for a long time. They've gotten comfortable. The thought of moving and getting rid of a lot of the stuff that they've accumulated they don't need any longer is a big situation for them. So some of the issues that they have to consider, of course, do they want to stay close to family? That's probably the number one consideration. You'll find with people 55 and over, they fall into two general categories when they do make this transition. One is they want to stay near their kids, not only so they can continue to see their kids, but when they have grandkids, they want to interface with their grandkids. Also, if they experience health issues as they get older, it's good to have family nearby you. And just the comfort with staying in a general geographic area that they've been in for many years. The second category of seniors, they relocate for one of two reasons. Number one, warmer climates. So, Florida, Arizona, areas like that are always popular destinations for seniors. And the second thing is housing affordability, generally speaking, especially if these folks are from the Northeast where housing prices are quite high. So they want to take advantage of selling their house in a higher priced area and then possibly reinvesting their house in a lower priced area where they can get more bang for their buck, or they can utilize less of their money to buy a home and they can have more of their other funds going to work for them so that they can maintain a high standard of living during their golden or retirement years. So there's a lot of issues that come up. So from a real estate point of view, because years ago I got my senior real estate specialist designation, and what that means, I had some advanced training into trying to put myself in the shoes of my consumer and determining what are the factors that are going to most impact them that I needed to really counsel them on. And for a lot of seniors, this process is overwhelming. And so it's not something that they do quickly, and it's something that they need to be in a consultative basis, not only with the realtor that's going to be helping them, but also in conjunction with their family, because it's always good if their family supports whatever move they're making. And so for the agent, that requires really two components: a lot of empathy and expertise in what you're going to recommend to the consumers, not only about how to sell their house, of course, but where they're going to buy. Are they going to buy locally, or are they going to go out of state? If they buy locally, what are the communities that would best suit their needs? Do they want to be in a 55 and over community, meaning that everybody's 55 and up? Or do they want to be in a more diverse community still? I would say the majority of folks that I've talked to over the years probably would opt for the 55 and over community. And of course, the 55 and over communities, besides having like-aged people, tend to have more of an emphasis on social activities. A lot of things, especially if these folks are retired, to keep them active and busy. Because one of the things that everybody learns over the years is that active and busy seniors are much happier and they have less health issues. When you tend to be retired and inactive and don't really interact with a lot of people, it's just not a positive situation for you. So some of the things that I've come up with over the years on how I try to help people in this category is I try to lead with understanding. I try to reframe the narrative, as I say, and I try to explain about how they're going to unlock equity and embrace a more specific lifestyle. I think educating my consumers, especially in this category, is very important on the type of products that are available. Also, a lot of seniors take advantage of bridge loans so they can buy before they sell if they need that help. There's lenders that focus more on bridge loans and cross-collateralized loans. And I try to communicate personally. I've been around a while, so I can obviously empathize with that age group. And of course, I have the senior real estate specialist training. So that's helped me quite a bit. But I think the bottom line on this explanation for people that are listening to the show, and maybe your parents are contemplating doing this, is try to be empathetic and let your parent make the decision along with giving them input as they ask you, and also make sure that the realtor is doing this in a group fashion so that everybody's on the same page and that the communications you're eliminating any misunderstandings and you're being fully transparent. So that's all for today in terms of real estate. Hopefully I covered some topics that are of interest to you. And everybody enjoy the upcoming nice weather. Stay healthy. And this is Marty Kaiser out.